Part 6. Bracketing, Trending, Market Balance, Trade Location, and Market Open Strategies. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." Welcome guys, and hopefully you managed to get everything done in your playbook in part 5 without much hindrance. So what we're going to talk about in part 6 is we're going to focus on, firstly, bracketing and trending markets. We're going to spend a little bit of time just understanding this principle, and I'm going to point out why it's absolutely crucial that you can define when markets are both trending and bracketing. We're then going to talk about a little bit of trade location and why it's important to understand that the price where the market is trading based on where it has come from is crucial to understand. You know, the strategy development as well as success is highly dependent on the trade location. And then we're also going to spend a little bit of time talking about some of the various open strategies that you can employ into your trading, and hopefully make some very good trade strategies based on that. So let's get straight into it, and let's kick off and talk a little bit about bracketing and trending market and what we actually mean when we refer to a market either bracketing or trending. So first, bracketing. A market is said to be bracketing when it exhibits two-way trade between buyers and sellers. Now, as you can see, a very basic example is what we have on the right. Let's first look at the handwritten drawing. As you can see, the market is bracketing between what we like to call support and resistance. Now, what I do want to point out, guys, is when I refer to support or resistance, I don't necessarily mean, at support, buyers are buying the market, or at resistance, sellers are selling the market. I merely mean this is the point where either sellers are stepping in at resistance or buyers are looking to take profits at those same resistance areas. So this is what we mean by bracketing. It's when a market starts to trade between two pivots and it respects those pivots and keeps bouncing between them. Then, buyers initiate buying at lower prices near the bottom of the bracket and will continue to show initiative until they begin to run into responsive sellers at higher prices. At this point, buyers will no longer be initiative. Once prices reach the top of the bracket, sellers will become slightly less responsive. Why? Because prices are advertised at a premium, and they will then begin to initiate short side trades until we reach fair value. And this continues to occur over a period of some time, whether it may be minutes, hours, days, even sometimes weeks, and even years in certain markets. Now note, this can occur across all time frame participants and all time frames. So it's not just exclusive to longer term time frames or some of the influential participants, but sometimes even algorithms will play these bracketing type plays. And we will talk a little bit about this as we start to develop strategies at a later point. Now note, markets tend to bracket 60 to 80% of the time, depending on fundamentals. So when there's a real lack of fundamentals in the market, we do tend to see a lot of the sideways trade. Now, if you want good examples of this, I remember distinctly, watching the E-mini S&Ps over sort of 2012, 13, and 14, when the Fed had employed all these QE strategies, and we saw, this very obnoxious, rally within the equity markets. And ever since sort of the back end of 2014, 2015, we've just seen most of the US equity indices moving sideways, moving in a bracketing type formation. So as you can see, even the most well-known markets can spend a long time, months and years, within these bracketing ranges. Now note, we will have 3 examples of different day types of bracketing, and we'll talk about those in a bit. So when a market is in a bracket, the views of all the relevant timeframe buyers and sellers are very closely aligned, and the odds of moving higher or lower are about equal. Crucial, you get that, guys. When a market's bracketing, being aggressive, looking for momentum plays at the wrong time can be extremely costly. I remember so distinctly my mentor once told me, it'll cost you so much money preempting a break or preempting momentum. The best thing to do is just wait for the break, wait for the momentum, and then begin to partake. So crucial you understand that when the markets are bracketing, the odds of continuation are very, very low, or the odds of momentum are very, very low. So if the odds are low, you're going to require extremely high reward to justify that trade. And a lot of the time you'll find that on 3 or 4 or 5 attempts of this, taking this momentum play, it's going to fail, and then eventually it does occur, and all you're doing is making losses back. So imperative you understand that basic principle. Now let's look at the other type, the trending type of market. So as you can see, a trending market occurs 20 to 30% of the time. Now, again, this is not a hard, fast percentage. What I'm trying to sort of point and get across with these percentages is that majority of the time the markets are bracketing and ranging, whereas very, very seldom or far less likely are markets trending. Now again, this varies, guys. When there's a lot of fundamentals in the market, when there's a lot of central bank action, then it's likely we see trends occurring more often. But central banks and fundamentals can go quiet for quite some time. I mean, take for example, 2014. We saw a lot of bracketing markets because there was very little going on, as all the central banks had kind of almost reached rock bottom and were already sort of into their QE program. So crucial you understand, that these bracketing and trending markets do change and they do shift. And the important thing for you to understand is not necessarily what the percentages are, but what are the identifiers of when we move between bracketing and trending markets. So let's look at trending markets and some of the characteristics. Firstly, markets are said to be trending when there is very little responsive other time frame participants. So remember, bracketing, we said buyers initiate at lower prices. They continue to initiate until they run into responsive sellers. When they run into responsive sellers, those sellers, as prices move higher, will eventually turn into initiative sellers. That initiative then forces prices lower, and eventually buyers stop initiating and they then turn to responsive buyers at lower prices again. And this continues over a period of time. Now, the reverse is the trending market. There is very little responsive. Now, just give you a basic example just to illustrate this. If you were to look at, for instance, this volume profile we have as an example. Let's say, for instance, that a new piece of news came out and that OPEC delegates had decided that they were going to pump to record oil inventories. And what occurred over the period of the day was prices continued to sell off all day. Now, straight away, you've got to say to yourself, who in their right mind, as a longer-term institution, it's influential, who would look to want to stand against something very, fundamentals that are very new to the market? And if you think of it that way, you'll quickly realize why no one would want to be a responsive buyer. Now, it's not to say that you won't get any kind of buying. Of course you will. This would be much shorter time frame buying, liquidity providers, with very short-term type strategies that would be providing some form of liquidity. But again, relatively speaking, there will be very little muted responsive buying. And that's the key to identifying whether a market is trending or bracketing. Then, we said to be trending when there's a strong divergence of price away from fair value. So again, it's crucial to always interpret and look, where was maybe the previous day's fair value? Where did the market accept price the previous day? As well as, how have we been accepting price over the last couple of sessions? If you find all of a sudden that, we've been accepting value relatively well, and all of a sudden on one day the market very quickly begins to move away from fair value, that's an early identifier of potential trend that could be developing. Then, trending when a series of day auctions moving in a clear direction, so one time framing. Again, I will illustrate one time framing for you at some point, but again, just important, one time framing is a control factor where we see the auctions moving in one direction. And then we have very minimal overlap of value areas. We will talk about overlap of value areas again at a later point. But by overlap, we merely mean, if the value area today was, say, between the price of 30 and 40, minimal overlap would mean if tomorrow we suddenly trade between 20 and 30. So very little overlap between today's value area and the previous value area. And then the end of a trend occurs in two distinct manners: initiative or responsive. And we're going to talk about this as we go a little further along. I'm going to show you some interesting examples, and we're going to develop some strategies based on finding those, not necessarily guessing where those tops are, but I'm going to show you a couple of key clues that the market gives you when it is trying to actually turn around and we run into some form of responsive buying or selling. So we get three parts to a trend phase, and this is crucial to understand because, again, you need to be thinking about these factors when developing your strategies. So you get the early part of a trend, which is the trend setters, and this is the phase where effectively a new piece of information is in the market. Participants want to aggressively initiate because prices are trading at an extreme discount or an extreme premium based on the new information. So that's the early part of the trend. We then have the mature part of the trend, or the maturing phase of the trend, and this is kind of the point where the information is still being priced. It's still relatively good to trade, but we're starting to run into a little bit more responsive type price action. And then we sort of got the end phase, which is where we run into other time frame initiative sellers or buyers, and that's the point where we almost get a little bit of an overshoot based on the information received. So important to understand that there are different phases to a trend. So whether you catch it early on or in the mature phase or in the late phase, you can develop various strategies just based on what point of the actual trend that we are in. Now, I'm sure you're well aware that markets don't just trend or bracket, and once they're done bracketing, they stop and then they start trending. It's all commingled, so it all occurs over time. Now, this is what we're going to talk about, is almost that transitioning between bracketing and trending markets. So straight away, what we're going to talk about is that, remember, price is simply an advertising mechanism. We've spoken about this. We've spoken about the elements of price, time, and volume. Now, certain prices or advertisements, they attract new business, and sometimes they're successful at attracting new business, and sometimes they're awful at attracting new business. Don't forget, the purpose of the market, the reason the markets were created, was to facilitate trade between a buyer and a seller. So what we have to ask ourselves is the very question is, how good is the market doing its job? So remember, any breakout from a balance area, from a consolidated area, from a bracketing area, this signals a revaluation of value. In other words, the market participants are trying to revalue what they deem fair value. Now, at this point, when we start to break out of, say, a bracket, all time frames are engaged. Why? Because we should only see initiative type response once we extend beyond the bracket's parameters. Crucial to understand, because when you do get the breaks of these sort of bracketed areas, you're going to get repositioning or new business, new positioning in the market. And that's why sometimes the breaks can look extremely aggressive. Alternatively, sometimes you get these aggressive reversals. And we're going to talk about these trade opportunities, because the important thing is not necessarily, the important thing to understand actually is that, the break point or the juncture point where the market decides we want to reprice or we fail to reprice, because there's so much activity in new business, it means there's new positioning. So either it goes and continues with the trend, or it fails and reverses, and that gives us very unique trade opportunities. So let's then, what I want you to do is I want you to imagine volume as a force. Now, for the market to be successfully auctioning, and we want to move away from a bracketed area or from an area that's been traded out for some time, we would need to see excessive force, so almost relatively very high force from what we've seen in the previous periods, whether that's whether that's days, weeks, or months. Now, think of that value area as, once we break away from it, think of it as almost like a gravitational, pull. And, as we're moving more and more away from it, either the market's going to accept that, now we're going to start repricing or accepting value somewhere else, or if we fail and there's not enough force and not enough initiative, we're going to very quickly snap back, almost like an elastic would snap if you were, if you were trying to shoot it. So That's the important thing to understand. If price exploration does not have force and volume, then the expectation is that price will be pulled back toward the value area. So important you understand, this basic concept. Now, once the auction is underway, rather than attempting to predict future prices, we instead observe as the market discovers future prices. So crucial. I see so many younger traders, looking at a chart, and they look at a chart from the perspective of where have we come from, and where are we likely to stop at a given future date. They're almost looking at the market and trying to preempt what the story might be, as opposed to living in the present and, trading the story as it's occurring. Now, I'm not suggesting that, going counter trend the markets is a bad thing. What I am suggesting is that there is a time and a place to both go with the market and go against the market. And that's why we spend a lot of time, developing our strategies based on objective analysis, because that's going to help us, take on trade opportunities. Not that we're guessing, or not that we're thinking where a market might do something, but rather, we're making good educated decisions based on factual information provided by the volume profiles. So, as traders, we continually assess the force and the health of the auction process in order to identify asymmetrical opportunities that can provide optimal trade location and, more importantly, trade location with less risk. So, ideally, in an ideal world situation, what we're looking for, if we're a momentum trader, we're looking to be momentum traders when there's a high probability for momentum. Equally, we're looking to be sort of almost, not necessarily fade traders, but we're looking to go counter trend when there's a lack of momentum, which is suggestive of a high probability, trade with less risk. So that is the crux of it, guys, is finding the optimal strategy based on the conditioning of the market. Now, just in the charts there, as you can see, we're talking about positive and negative skew. So what I'm trying to illustrate to you there is that when there is positive skew, when there's non-symmetrical type markets, that is when there's a higher probability or a lean for the markets to continue moving in, not necessarily an aggressive trending manner, but at least moving in, there's a higher probability to either move up or move down. And that's what I'm trying to illustrate, is if you can identify when there's a high probability to move up or down versus when there's a high likelihood we're just going to keep balancing, then you can employ some very effective strategies and you can reduce your ultimate risk. So, note, a bracketed market has already confirmed auctioning on both sides, whilst bracketing is still busy confirming. The trade strategies used will vary in both instances. In a bracketed market, one can be passive on entry as other influential timeframes are responsive, where a market that is trying to bracket has a slightly skewed risk, as we are seeing responsive price response, but also initiative from the trending timeframe. Therefore, we take on more risk preempting a bracketing market than a bracketed market. So all I'm trying to say to you is very simple. If a market has established itself as a bracketing market, in other words, we have clear areas where, we're finding that there's resistance, for buyers to buy higher or initiate higher, and sellers respond. And then equally on the flip side, sellers, initiated higher prices, and then, buyers responded lower prices. So if there's clear defined bracketing already, then as traders, we want to initiate strategies where we are a little bit more passive and we allow the market to come and tag us and fill us in, and we respond to those higher prices and to those low prices. However, if a market is still trying to bracket, it's still trying to show the parameters of a bracket, then there's a little bit of a higher risk preempting that little bracket. So what we then need to do is we need to wait and allow the market to show us its hand, show us that actually it does want to bracket before we start initiating trade. So that's all I'm trying to illustrate, is the difference in odds or the difference in risk that you're taking when you're looking at a market that is bracketed already, or when a market is looking to form some form of a bracket. So just understand that very important difference between the two. Let's now go and have a look at a chart of what bracketing and trending would look like put together. So the example we've used is basically in an upward auction, we assess whether higher prices are cutting off activity or creating increased interest. Now remember what I said to you. The objective of any market is to facilitate trade. So when prices move higher, is it bringing in new business? In other words, is it saying, more buyers need to come in and initiate? Or is it getting responsive sellers into the market? And that's the question you have to answer yourself, because if it's facilitating new business, there's a high probability that we're going to get strong initiative and momentum continuation. Whereas if it's cutting off activity, it's likely we're going to get some form of reversion type opportunity. So if high prices are increasing the bidding, so more buyers coming in, the risk of being long is low. If short, the odds of suffering a loss are greatly increased. So again, just coming back to that concept of just knowing whether or not we're bracketing or trending can increase or decrease the odds of success and obviously compounding potential losses. So that's important to understand, and that's why we spend quite a bit of time understanding the principle and the premise behind bracketing and trending markets. So what you've got is the example here. It's a candlestick chart. Now, the reason I like to use a candlestick chart for this and not necessarily a volume profile is because it's a good way to illustrate what we mean by looking at bracketing and trending. More importantly, I can show you what the volatility will look like or the range expansion will look like when we do have a little bit of initiative and then return back to bracketing. So looking at the examples, you can see from left to right, initially the market spends in this little box, in this blue box. You can see the market just almost pinging off a lower bound and an upper bound. Now note, not support, not resistance. So what we get is we get buyers that respond at lower prices and they then initiate until such a point as they run into responsive sellers. When they run into those responsive sellers, they then back off and we then start to see sellers initiating until they run into, again, responsive buyers. So that's what we get initially, a little bit of two-way trade, and we keep pinging between these 2 points. Then all of a sudden, you can see 3 relatively aggressive candles as we move outside of the initial bracket. Now note, the first thing to understand is look at the size of the 3 candles. Now, the reason I like to talk about candles in this respect, and I will show you this in profile examples later on, but look at the size and the length of those candles. Note how they're the biggest 3 candles we have in this entire, since the beginning of this chart. Now, that already shows us initiative. It shows us that we're seeing a little bit of control factor coming in on the short side. So, again, straight away, one of the clues you need to pick up, when a market moves outside of a bracket, remember what we said, we need excessive force to get the market to move away from what it deems fair value. And then as you can see, remember, we get the initiative from the sellers until such a point as it runs into responsive buying. Once it runs into that responsive buying, sellers will then ease off the initiative and prices will start to drift higher. Note then, we move into our second bracketing example where the market just trades between 2 points. Now what I want to point out is that when we do have initiative moves, and this is a little bit of a clue or a hint as to what we're going to be talking about in strategies later on, but when there is initiative, that initiative point or that break point becomes an extremely important pivot in the market that sellers or that whoever initiated needs to defend. So as you can see, the first time we retest that break point or that dotted line, you can see how the market sort of respects it, and we see sort of not just buyers back off the initiation, but we see sellers stepping in and initiating fresh shorts again. So again, we can see the market enters a second sort of bracketing example. Finally, once we take out that key pivot where the sellers initially initiated, note how the market then moves back into the original bracket. Now, again, this is not something that's new. You're going to see this very, very often, the market moving in and out of bracketing areas. The important thing to understand is when are we bracketing and when are we initiating or trending. So again, we then have our third box, another example of bracketing between buyers and sellers. Again, note how when we saw the initiation in the first box, that key level where that dotted line is now acts again as an area where we have responsive buying. So what was initially sort of almost call it support then became resistance and has now become support again. And then again, note how once we take out that area, we get initiative again from the sellers until they run into responsive buys, etc., etc., etc. So this continues to occur over a period of time. So what I want to point out and illustrate to you is that trade location, and we're going to talk a lot about trade location in the coming slides. Trade location defines our risk. In other words, what I mean by that, if we are looking for buy-side trades, in that first box, for instance, in the first bracketing, if we're looking for buy-side trades towards the high, momentum trades, we're taking on a lot more risk. Equally, if we're looking for sell-side trades towards the bottom of it, we are taking on high risk. However, once we break and show the force behind the selling and the initiative, then there's a high probability opportunity to look for momentum plays or trending type plays. So just note the crucial difference there. It's okay to interpret a market being sideways and having a potential to break, but it's imperative that you don't preempt the break, but rather wait for those clues, wait for those little signals, and then go with the momentum. Now we're going to get to the point where we talk about how do we identify when a market moves from trending back into bracketing. I'm going to show you 3 nice little setups, strategies, techniques you can use to observe and identify potential turning points. We will develop these strategies also further on the blackboard later on. So let's go through them one by one. So there are 2 methods, but 3 examples that we're going to talk about when we talk about potential turning points from a trend back into bracketing. Now the first one is the less frequent one, which is a loss of momentum. So almost like, we have a flurry of force, some very strong initiative buying, and all of a sudden, prices are moving higher and higher and advertising higher and higher prices. All of a sudden, there's just a real lack of interest to show initiative at higher prices. So it's not to say that buyers don't want to be long, it's just that they don't want to show initiative at higher prices. Now, at this point, volume simply dries up, or the lack of interest in new business dries up. Now, we need that new business in order to continue to see the market initiating at higher prices. So if everyone is fully committed and no one is left to participate, well then it's very simple. There's a lot of, you'll have obviously the initial longs that bought at the beginning of the trend. You'll have more longs that bought sort of in the mature phase. And then you'll have some weaker longs that bought sort of at the back end of the trend. And those weaker longs are likely to be the first ones that will liquidate those longs, and then we ultimately start bracketing. So this is the first sort of example that we will talk about when we talk about potential reversals in the market, and I'm going to show you examples and how they look in the volume profiles in the slides ahead. The next example is what we call an excess top. Again, this is probably the most frequent kind of top. As I would have spoken to you about in Module 1, this is the kind of top where we see a tail in the market, or we almost see the market goes from initiative, it runs into responsive other time frame players, and then quickly backs off as prices are being advertised at either a discount or a premium. So the market makes a dramatic move higher or low, so that's the initiative. Again, this can be on I don't like to say lower volume necessarily, but relatively okay volume. So nothing flash, nothing amazing. And what you then see is quite a quick reversal. And the setup I'm going to show you is called a V reversal, or an inverted V reversal. And so effectively, we get quite a strong auction reversal process, and this can be done. It doesn't have to be on low volume; it can be on high volume, but we tend to see this done on relatively sort of average kind of volume. So this is our second kind of top, which we'll talk about. Now, a more sort of almost dramatic and exciting sort of excess top would be our third example. So just note, an excessive reversal can appear to be on high volume. So it can look as though something crazy is going on in the market, and there's a lot of aggressiveness, and there's almost aggressive trend. But the important thing to understand is the high volume isn't on the excess. In other words, it isn't from the buyers buying up and initiating at higher prices, but it's actually on these higher prices bringing in other responsive sellers. So, and again, vice versa, obviously it could be to the downside as well. So it's those higher prices being advertised that bring response from the other time frame, and that is what creates potential for high volume. But note again, this doesn't have to be on high volume, it can be on low or higher volume. Now, the more excessive and aggressive version of this, excess top it's what we call a strong excess reversal. And how we identify between the two is very simple. When we get a strong excess reversal, we tend to see a pickup in the volatility, so range expansion. We see quite a lot of volume, and we see excessive prices. So we see a combination of volatility, volume, and excessive prices. Whereas in just an excess top, we tend to see, a pickup in relative volume and obviously a reversal. So the big difference here is we see the volatility and the volume change quite dramatically. Now, the reason we want to identify and differentiate between these two types is that when we have these real sort of excessive type tops being formed, we get very strong reversals, but more important, the tops or bottoms they make become crucially important pivot points, and that's why we identify between the two, because a top that's made on volatility, volume, and excessive prices is far likely to hold for a longer period of time, and it does usually signal almost like the end of a trending market. So that's why we want to differentiate between the two. Now, what we can say, which is important, and this is a phrase that quite a few sort of professionals like to use, is that highs and lows in market, in other words, longer term highs and lows. And again, I use the word longer term in a relative manner, okay? You could be a day trader, and it could be the high for the day. You could be a weekly trader or a monthly trader, and this could be that high. So highs and lows tend to be made on increased volatility. So what I'm trying to point out is that when we see this, extreme excess tops and bottoms, all right, they tend to be made on volatility, volume, and very, very excess prices, and they tend to hold for a long period of time. And that's why we definitely identify between the two types of excessive tops. So let's now go and have a look at what these examples are. I'm going to show you how all three of them look, and then hopefully you can develop a better understanding. So our first example, as you'll recall, is the one where we just simply lose momentum, okay? This is the less frequent kind of top you're going to see. So as you can see in the chart or in the volume profile, we have a lot of TPO overlap at this high. So you can see almost the S, the T, the U, the V, and the W print, almost all sort of sitting at these prices, these higher prices being advertised, but there's a real lack of interest to initiate another move higher. So it's almost like, buyers and sellers are saying, well, we're happily, accepting that the market is now trading these prices. So again, we can see that this is just almost like a slow, just a slowing type of momentum that's occurring at the high of the day. Now, some of the questions we need to ask ourselves, when we talk about these three different tops being formed is, firstly, remember, when a market is moving either up or down, I like to have a phrase and just remind myself that it takes time for a big ship to turn around. So remember, the market equally is a big ship. So it does take time to turn around a lot of the time. And, knowing this again will keep you from, maybe fading very aggressive trends too soon, but also it'll make you just be that little bit patient to wait for some form of objectivity that the volume profile can potentially show you. And what you can see in this example is how we can see that real loss of momentum. We got the initiative early on from buyers, and then there was just a real lack of interest and a real lack of new business at the higher prices. So that was sort of our clue that a potential loss of momentum was occurring. Now, remember, when we get this loss of momentum type top, it's not a particularly strong top. It's merely just a short-term turning point where buyers don't want to initiate higher just yet. And so at that point, we start to get a little more two-way trade. Now, some of the questions we need to ask ourselves when talking and thinking about these kinds of tops is, what kind of volume is being traded at the extreme? And what you'll tend to find is that there's not aggressive kind of volume, but a lot of two-way trade between buyers and sellers. So, we'll see a lot of trade being facilitated at the highs and lows. And remember what we said, in a very strong auction process, we don't want to see a lot of facilitation at what we deem premium prices or discount prices. When we see this, a high amount of volume being facilitated, is telling us there's quite a lot of acceptance, at that price point. And remember, highs and lows are not made on acceptance. Rather, they're made on sort of initiative being taken from sellers at higher prices as prices are advertised at a premium, and likewise for buyers when prices are being priced at a discount. Then, what kind of auction is occurring at the extreme? So again, note, at very aggressive tops and bottoms, we tend to see a strong auction process. Sellers take advantage of premium prices and buyers don't buy at premium prices. So again, in this example, we see a lot of two-way trade between the buyers and sellers. So again, whilst the market did back away off these higher prices, it is telling us about the kind of top that is in the market, and more importantly, the likelihood or the probability that at some point in the future we'll either retest or take out that high and new buyers then continue to move prices higher. And lastly, the rotation and the speed on the way down. Remember what I said to you. As these buyers run into responsive sellers at higher prices, if those responsive sellers turn and become initiative sellers, the market will very quickly reverse what it did on the upside. So the mere fact that, not only did, we have almost a slowish type reversal, but again a retest, is very suggestive that, that this market sort of, whilst there was a little bit of initiative taken from the sellers, we do want to assess, how the buyers and sellers are interacting at various prices. When there's an aggressive interaction at higher prices, that is telling us one thing. When there's not such an aggressive interaction, that's telling us another thing. What's imperative to understand is this kind of interaction, because that will determine what prices are likely to do going forward. Let's now look at the second example, which is an excess top. Now straight away, if you look at the picture without me even bringing down the text, you can see how the market, once we sort of ran into a price point where prices were being advertised almost at an extreme or an excess point where it was a very, very good premium price, we saw how quickly the sellers interacted and they very quickly shut off the buying and took the prices back lower down. So what we want to gain, sort of remember is that excess tops can be made on relatively low volume or high volume. There's no hard, fast rule. The important thing to understand is the auctioning that occurs at the highs or the lows when we form an excess top. Now, what you traditionally see on the volume profile is some form of a tail. Again, the length of the tail, depending on the market you're trading, is crucial because that is telling us how quickly the other time frame was shut back down. So in this example, we can see not the biggest tail in the world, but a relatively sort of bigger tail, and that's telling us that sellers very quickly shut down the buyers that were initiating and move prices quite quickly lower. Note as well how we, once we auctioned that top, once we found that top, the market then very quickly navigated away from that top and sellers took complete control and continued to initiate prices. And we even took out the low of the day and extended towards the downside. So we can see we saw some real strong initiative being taken by the sellers and the buyers got overwhelmed in this example. So again, we can see how these excess top, not only do they give us, the tail gave us an early clue, but it gave us quite a bit of opportunity to hop on with the initiative selling that continued to occur over the course of the day. Then note the volume at the extreme. Right, we could see, where in the first example with a loss of momentum, we saw a lot of two-way trade. In this example, in the top quartile or in the higher prices, we would have seen a real lack of volume being facilitated between buyers and sellers. Why? Because, well, the buyers got shut down very quickly. So there was a lack of interest from buyers to be buying at higher prices, and sellers quickly took advantage of those higher prices. Thus, we wouldn't have had as much two-way trade as we would have had in the first example used. And then the rotation and the speed on the way down. Like I said in the earlier slide, it's all about assessing how does the market, move back down. Is it aggressive, in which case we're seeing aggressive initiative, or is it a lot more slow, where we're seeing a lot more two-way interaction? Let's go to the third example and talk about sort of the aggressive excess top and see how that one looks on a chart. Now, as you'll see, just looking at the chart again, very, very similar to the second example, except this time round, the two major differences are, note, the size of the tail, so the size and the speed of the rejection, but also then the rotation down. What we saw in the second example was there was still quite a bit of, as we were moving down, there was two-way trade being facilitated as buyers were responding as prices moved lower. In this example, however, note how we see very little buying response until the market almost rushes and aggressively sells off and rushes back into responsive buying. So crucial to identify the two major differences. One, the excessive initiative taken from sellers at the higher prices, but then also the aggressive initiative taken even as prices continued to move lower. So there was a lack of response from buyers, and that's what created the aggressive move down. So note, remember we said the aggressive excess top, it includes three things: volume, volatility, and a loss of momentum. So in terms of volatility, what do we mean by that? Well, if you look at the size of the two candles or the three candles before we formed the Y tail top, you can see that there's quite a bit of overlap between prices, a lot of inside type trade, a lot of two-way trade between buyers and sellers. And then all of a sudden, we get this Y tail being formed, but it takes out, the Y tail is the largest, TPO candle on the entire day. So it has the biggest range of the entire day, and that's that shift in volatility. That's that pickup in volatility and volume that we're talking about. And, when we see that kind of auctioning process or aggressive process, we want to then avoid trying to be a responsive buyer and rather go with the initiative selling. So again, note the tail, again, the auction at the extreme or the lack of two-way trade at the extreme. There was only initiative selling at this extreme. And again, note we would have had very little volume being traded at that top. Why? Because no new business would have been buying at those highs, and equally, we would have seen very quick rejection of premium prices. Okay, that then concludes our three examples of the types of tops that we can expect. What we are going to talk about later on when we go to the blackboard is how you can take advantage of these three different opportunities and develop your own strategies. So two strategies we're going to discuss in lengthy details, and I'm going to sort of draw them out for you on the blackboard and explain the pinch points, the trigger points, the initiative points, the responsive points. Those two examples will include firstly a breakout of a bracket or a triple inside day or an inside day. So we're going to talk about how we can take advantage of moving from a bracketing market to a trending market. The second example then is we're going to talk about a trend V reversal. So remember we had three sort of reversal type plays. One was a loss of momentum, one was an excessive high, and one was an extreme excessive high, high or low. And so we're going to look at the third example because this is the one that has got the easiest trade strategy to develop because we're getting that initiative type price response. Now, before we go into those examples, there are a few key, sort of principles that you need to think about, not just when you're developing your own strategies, but whilst I'm showing you these trade strategies. So these three key principles are as follows. The best trades often fly in the face of the most recent market activity. So what do we mean by that? You remember what I said to you in earlier slides, how if something's very obvious, if there's a lot of information that is obviously available to the market, then sometimes the best thing to do is actually what everyone else isn't doing. So that's what we're trying to say here, and that's why V reversals work so well, because everyone is caught still trying to, sort of go with the prevailing trend, and what they're actually sort of forgetting is that we've got a very strong objective clue in the market that trend has now come to an end. So sometimes the best trades to do are the ones that go against the most recent market activity. Now, I'm not saying you should be fading every kind of move. What I am saying is when there's enough objectivity in the market, enough early clues, that is when you want to go against the most recent market activity. Our second key principle, never lose sight of the big picture. Never lose sight of what the underlying trend is. Are we bracketing? Are we trending? Whenever you develop a strategy, make sure you keep in mind the big picture. And then lastly, the more confirmation in a market, in other words, the more confirmation you wait for, or the more confirmation the market is giving you, the reduced probability of success, or the reduced probability of positive outcome. So important you understand that the more obvious, the less likely you are going to have a big winner. Why? Because it's very obvious, not just to yourself, but to everyone else. Let's now turn our attention to the blackboard and let's go over these two trade strategies, and I can show you where some of the interaction is, the trigger points, and how you would take advantage of these two basic strategies. Alright guys, let's take a look at a basic example of what we mean by bracketing versus trending markets. Now, the reason I want to almost annotate this for you is to just show you how the markets don't simply stop and then go sideways and then trend again. There's very important key identifiers that will move us from bracketing into trending and vice versa. So very basically, what do we mean by bracketing? Well, as markets move up, we see a little bit of initiative, we then run into a little bit of responsive selling, the market then starts to rotate over, those buyers then get out of those long positions and sell, that takes the market lower until we run into, again, responsive buyers, and we continue and continue and continue. Now, remember, markets can bracket or move sideways for a lot longer than you think. In actual fact, markets tend to move sideways for very, very long periods of time. Now, one of the key things that will, can obviously shift us from, a bracketing to a trending market is a shift in fundamentals. Now, what you have to ask yourself is how often do we get, very big fundamental shifts? Now, what I would say to you is, in my career, in the early years, we had the European crisis, and we had all the central banks cutting interest rates, and there was a lot of panic around, would Europe continue to exist? So, back in those years of 2010, 2011, 2012, there was a high tendency for a lot of trend in the markets with very brief periods of bracketing. But that then in 2013, 2014, 2015, stopped. We saw most markets move into bracketing type price action. Now, fundamentals is one of the key factors that can obviously shift us from bracketing to trending. Another key factor is when we have very key technical shifts. Now, what do we mean by that? Well, if, for instance, we take an example, we look at the euro-dollar index, and we can see that, since late 2014, we've had this really strong rally in the euro-dollar index, and we had this initiative, type trend, and then the market started to bracket. And then all of a sudden, since the Donald Trump victory, we've started to see that trend continue. So the second type of main reason or cause that we get a market moving from bracketing to trending would be very key technical breaks. Now, what do I mean by key technical breaks? And this is important to understand. I don't mean daily market moves. I don't mean little bits of volatility in the markets or pockets of noise. I mean very strong initiative signals sent by the market where day after day after day the market holds that break above this consolidation, and maybe even 1 or 2 or 3 weeks we hold that break, almost like the market saying, well, we've moved away from where we thought fair value was, and we feel now that the trend needs to continue. So that's what we mean by a key technical break. It's the point where the technical structure of the market brings bigger time frame players into the market. That's the two key reasons or ways in which we move from bracketing to a trending market. So let's just illustrate now and finish off, just in terms of how it would work and what causes us to move from bracketing to trending. So as you can see in this initial example, the market is bracketing. Now let's say we get a key piece of fundamental news in this market that drives us outside of the bracket. Now the first point you have to pause, first point you have to look at as a trader is that juncture point there, that key break. What occurs in that area? That's one of the most important things to interpret, because you need to understand, is it initiative taking it through there? Is it merely the buyers that are long, that are liquidating, that's taking it lower? Or is it fresh new business coming into the market that's taking it lower? Okay, understanding and interpreting that basic principle will then allow you to interpret whether or not we continue in that direction, whether we continue aggressively in that direction, whether we grind in that direction, or whether we turn back around and aggressively reverse. Okay, so the important thing to understand is what we should see. The expectation is that we should see some initiative selling at this area. In other words, new business. So with initiative selling, we would most likely see a very directional type move. Okay, so straight away, you've got to cotton on or look at how the market responds in this area. Does it look like initiative, or does it just look like sellers that are half-heartedly committing to lower prices? In which case, maybe we get the grind type phase, or equally, we just get a stop run and the market turns back around and continues to bracket. Now remember what I said, guys. When a market does bracket and trend, if we do then reverse up higher, it's highly likely we find new ground to the upside and then continue to do the same thing higher up before the market then either moves higher or back lower again. Let's just finish off and wrap up. Remember, markets trend, say, if we were to do a relative study, markets are trending roughly 20% of the time relative to the 80% of the time they bracket. Now, the important thing to understand is that when you're employing your strategies, are you employing momentum strategies? Are you employing fade strategies? What strategies are you utilizing? And how are you going to implement them differently in, say, a bracketing market or a trending market? That's the wrap up and the end of our example. I hope you've enjoyed this.
Two concepts that a lot of people like to use, but more often not they don't understand, is volume and volatility. We're going to talk about volume and volatility, and I'm going to show you how to use these two tools to your advantage, not just in volume profiling, but in any trading. So what we're going to talk about firstly is volume. Now, remember what we said, volume is showing us, the how good or how successful the auction process is taking place. Don't forget, the objective of the market is to facilitate trade. So if there is a high amount of volume, the market's doing a good job. Why? Because it's facilitating buyers and sellers, or it's facilitating a high amount of trade. So firstly, remember, volume on its own means nothing. It tells us nothing. If you just look at volume, you have high volume, you have low volume. That does not tell us anything about future prices. Okay? We need to see the advertisement of prices with the volume to have any kind of meaningful information, but also to make an objective type statement. So high volume, it means trade is being facilitated well. Low volume means there's a high probability for mean reversion. In other words, remember we said volume is like force. When there's a lot of force in the market, we should be seeing prices move aggressively up or aggressively down. Okay, if it's not moving aggressive, or if it is moving aggressively up and down but on lower volume, it's very likely that we're going to revisit those prices at some point. Why? Because it's not new business taking those prices up or down. So the fact that it's not new business means it's highly likely that we do retest those prices again at some point. Now note, volume is a relative tool, so it's all about understanding how volume is changing over a given period of time. So what I mean by that, if you're sitting, and let's take for example a weekly type strategy where the market's moving relatively sideways on lower volume. all of a sudden, on any given day, the market volume doubles what we've seen over the average of the last 10 trading sessions. This very aggressive relative change in volume is telling us that new business is being brought into the market. Now, that how it impacts prices is all determined on a number of factors like trade location and some of the where we are trading within a bracket and all sorts of things. So on its own, it doesn't mean something, but the fact that there's a strong relative change in volume, that is something we want to identify and pay attention to. Then, just some of the things I would use volume for and I'd pay attention to is, as you can see in the example provided, I've got two colors there. I've got a red line and an orange line on the volume bars. Now, that for me is showing what is relatively high or relatively low volume based on a previous number of sessions. And I identify that because it's easy for me to then see when all of a sudden, there's a high amount of volume or new business coming into the market. Equally, I have moving averages on the volume, so I can see how, on average, the volume is changing, and I can see if there's a sudden relative shift in volume. And then obviously the ranges that we see in terms of the volume. Sometimes volume will be sitting in, say, doing roughly 20,000 contracts every half hour for a number of half hours. So if you know what the average is and then the sudden shift, you can quickly pick up on the shift in the relative change that is occurring within the volume. And more importantly, you can then develop strategies based on these relative changes. So to finish, remember, high relative volume is indicative of initiative being taken from the buyers or the sellers, which happen to be influential participants. So when you see a relatively strong shift in the volume, towards the upside, we can see a little bit of initiative coming into the market, and then we need to be cautious going against that initiative. And that is why we sort of talk a lot about volume quite extensively. Let's now have a look what we mean by volatility. One of the most common misconceptions when it comes to volatility is that a lot of people assume volatility means that we have a pickup in volume, and this is not quite true, right? Volatility is merely when the variation from the mean expands. So the best example to use, as we can see in the picture there, is those in that first picture is the Bollinger Bands. Now, Bollinger Bands show us when there's a pickup in volatility or a variance around the current mean. Now, when we see that volatility, again, on its own, it means relatively little. Okay, note, a pickup in volatility does not mean there's initiative in the market. It just means that we very quickly, price is moving quite aggressively away from its current mean. However, what I would say is that when you get volatility and volume together, that does imply initiative, and that is something we have to pay attention to, not just when we're trading, but when we're developing various strategies. So note again, volatility is where we get range expansion. So if you're used to seeing the market, doing maybe on average 10 prices per half hour or hour, all of a sudden we're seeing something like 20 prices, 30 prices every hour. So we get that range expansion. As you can see in the second chart, that's just a basic, sort of a bar chart illustrating the, the change in range. And you can see how the range, more or less, it will average a certain amount of, prices. And then all of a sudden you get these volatility spikes. The question you have to ask yourself when you get that volatility spike, is it accompanied by higher volume? If it is, that's initiative, that's new business, and that's not something we want to be going against. More importantly, that's something we want to highlight on the chart, because when new business enters the market, they tend to leave key pivot points. So note, low volume volatility equals high probability for counter trend strategy. So like I said to you, volatility on its own is not good enough. When we have volatility and low volume, we do tend to revisit, sort of those initial starting prices. And as you can see in that first example, we got that very aggressive move and shift in the Bollinger Bands, but we can see eventually once the market, sort of found a low, it did start to rotate higher and retest those sort of higher prices later on in the session. So again, that's now our volume and volatility explained, and hopefully you understand these concepts a little bit better, but more importantly, hopefully you can now start to use these two very important principles when developing your strategies.
So welcome to part 6A summary. We're going to talk firstly about bracketing and trending. We went through a couple of very nice examples. I showed you what we mean by bracketing and trending and how we move between bracketing and trending. So the first thing we're going to go through is, what were the three types of ways or methods in which a market can move from bracketing to trending. And the first one we spoke about was a loss of momentum. And what we spoke about here was where the market effectively just runs out of steam. So a graphic depiction, the market's moving sideways, we then start to break out, we distribute higher, and the market just runs out of momentum and starts to turn back over before then bracketing again. So effectively that was the first type of example we spoke about. We then had our second example, which is the excess, or where the market is initiative and runs into some strong type of responsive type price action. And that we called effectively a V, or an inverse V type pattern. This looked like on the chart where we would have a distribution, a little bit of bracketing, we would then have an extension, and a very quick reversal. Equally, we could have it to the downside where we continue, and have a relatively quick reversal. That was our excess type example. And then we moved on and we spoke about the most aggressive, which is also a form of excess, but it includes volume, volatility, and a very excessive price. So that was the major difference between excess and the major excess. Now, the key that we identified with major excess example is that these tend to act as very good high and low swing points for some period of time. So when you see these excess tops made on volume, volatility, and excess prices, they tend to hold for some time. And a good example to look at is particularly the gold when we shot above the the 1900 level, as well as the oil when it was trading around the $140 a barrel. So those are the two very strong examples you want to look at for excess type highs and lows in the market. We then moved on and we discussed the idea of volume and volatility. And there were some very key points to look at in terms of volume and volatility. The key takeaway is, remember, volume is a relative tool. It allows us to measure the manner in which trade is being facilitated. High volume is very indicative of a lot of new business coming into the marketplace at various prices, whereas low volume is far more indicative of less new business and maybe a lot more passive type trade. So it's a wonderful relative tool, and we went through a lot of key understandings of why we use volume in developing our various strategies, as well as obviously volatility. Remember, volatility does not necessarily imply liquidity. Volatility does not necessarily imply more volume. Volatility just implies the market moving over a much bigger variance around the mean. So we distribute ourselves in a bigger type range than usual. Now, let's discuss a unique trade strategy that you can utilize and develop over time. Now, the strategy I'm going to show you is when we have a high volume breakout. So what this example would look like, and I'm going to combine it with a bracketing and trending example, is let's say, for instance, the market or the day has been distributing for some time. So the market is distributing, we're sitting inside the day's range, and we're auctioning up, and we're auctioning down, and we're auctioning up. We then take out a key area or a key reference point in the market, which is the high of the distribution. Now, if we see a very large pickup in volume, so let's say on average over the course of the day we've been seeing lots of little volume bars, and all of a sudden we see almost 3 times or 4 times the volume being traded over a period of a session on the break of this key reference point.
that volume is a key identifier of new business that has come into the market. Now, when that new business comes into the market, firstly, we do not, rule number one, no fading. So we do not want to employ strategies that suggest we go against volume. So straight away, if you can employ a rule of thumb rule into your trading, which is to not go against high volume moves up or down, you're already going to, sort of avoid a lot of pitfalls that a lot of traders make. So that's the step one. When you see that high volume, that relatively high volume, we don't want to go against it. Most important, we actually want to employ momentum type strategy. So we're looking for a continuation type pattern, and ideally we want to see quite a continuation of initiative. Again, how do we measure initiative and strength? Well, the depth in the pullbacks. Can the market pull back? Are there responsive sellers actually stepping into sell it, or are they merely just short-term sellers providing liquidity? So that would be our unique key strategy when we break out of a bracket or a market that's been bracketing for maybe a few auctions or maybe even a few days. The key is we want to see volume and, note, volatility on the break above on that trigger point. So that's our key unique trade strategy that we're going to deal with in part 6A. Go and complete the rest of part 6, and we'll see you again for the Blackboard series in part 6B.
We're now going to begin developing the concept of trade location. In other words, where we are trading relative to sort of previous prices. And we're going to start off and talk about, where the market opens, whether it's in balance or out of balance. Now, as you can see, the guy on the tightrope, he's balancing quite nicely. And the basic illustration here is that when the market is in balance, there tends to be a lot of control, a lot of two-way trade being facilitated. However, if all of a sudden things become shaky on the tightrope, then we start to see a little bit of panic, a little bit of volatility, a little bit of range expansion. And that is why we want to differentiate between a market that is in balance and a market that is out of balance. So, as we can see, a market that is in balance, it opens within the previous day's value area. So, where the market accepted prices the previous day, where buyers and sellers said, we are happy to agree as this being the fairest price on the day, if we open in and around that fair value, the market is said to be in balance. Now, remember, when we're in balance, the market is said to be in firm control. Now, remember, when we are in balance, there's a lower risk, and therefore less opportunity. So what we mean by that is that there's a 50-50 chance when we're in balance that the market goes up or that it goes down. So again, there's slightly less opportunity or slightly less conviction in terms of the market either going up or going down. So crucial you understand that, because again it brings us back to that concept of, do we want to be aggressive when the market is not showing that sort of aggressiveness? Now, more time is spent within when we are in balance. We do tend to spend a lot of time, trading within the previous day's value area. So it's almost like the market says, we accepted these prices the day before. There's a higher probability we're going to initially accept these prices again today, whilst we await further information. Now, the opposite to that is where a market opens out of balance. Now, when we open out of balance, we're opening outside of the value area or the accepted area of the previous day. So we almost, get this idea where the market said, previously the day before we accepted these prices, and now today we're going to open, lower or higher than where we accepted, and then, we're going to decide, do we re-enter the previous day's accepted area? Do we accept a new area today? So again, the mere fact that we're opening out of balance creates an indecision. It creates a little bit of uncertainty, a little bit of volatility, and that brings opportunity with it. So again, there's a higher risk when we do open out of balance. Why? Because there's that uncertainty, there's that potential to move one way or the other. But the fact that we're going to move one way or the other because we're out of balance suggests there are likely to be more opportunities. Let's have a look at what these would look like now on a volume profile. With the two examples provided, the one on the left, you can see we have 2 days of volume profiles. Now,
Remember, the star is effectively where the market closed the day before, with the orange area being the value area, or the volume area, the area in which buyers and sellers agreed on fair price. Now, as you can see, the O, or that the little blue box there, that is effectively where the market opened the next session. And what we can see is that not only did it open, fractionally below the previous day's close, or even fractionally, below the previous day's most accepted price, which is the volume point of control. So we can see this market is kind of opened exactly where it closed on the previous day. So we're firmly in balance. The market is, it's opened and it said, well, we're still in the same area where we accepted prices the previous day. And again, remember what I said to you, when we open in balance, there's a high probability the market's going to continue to balance until it gets further information. As you'll see in this example, the market had an almost completely overlapping value area. So for the second day in a row, the market accepted, buyers and sellers accepted the same set of prices as it did in the previous session. So as you can see, a real lack of volatility and opportunity when the markets are in balance. Again, note, when I talk about a lack of opportunity, I don't necessarily mean we cannot make money. Of course we can. But the likelihood for initiative type price action, aggressive, volatile price action is reduced. And that, understanding that mere fact means that we need to turn our attention away from momentum, aggressive type pattern plays to more sort of passive and rotational type pattern plays. And again, we will develop these strategies as we head toward the back end of this module, as well as module 3. The second example is where we open out of balance. Now note, we can see by the orange area, that's where the previous day's value was accepted. We then opened right at the high end of the previous day's range. So straight away the market is out of balance, it's unsure, there's a lot of, almost panic, people are not sure what to make of it because, we accepted prices a lot lower on the previous day and now suddenly we're trading much, much higher prices. So there's a lot of two-way indecision, a lot more participants are now dragged in and forced to respond to these higher prices. And that creates volatility, and that creates the potential for opportunity. Now, what I will say as a rule of thumb, when a market tends to open out of balance, we do tend to get a little bit more volatility. Note, not necessarily volume, but volatility. So we tend to get a lot of more sort of what is seemingly aggressive up and down moves. Now, let's move to the next section, which is the opening trade. The open is quite possibly one of the most crucial times of the day. And the reason dates back to sort of a little bit in history. And the reason was that what you tended to find was a lot of institutions and brokerages used to execute right on the open after receiving, the client orders overnight or the instructions as to what they needed to do. And that's why, back in the day, the open used to be absolutely pivotal and you used to get most of the volume and volatility and business done, within the first hour of trade. However, nowadays, whilst you do still get a lot of interaction and movement on the open, because of the extended trading hours and because there's a lot more sort of ways in which you can execute successfully, we tend to find that whilst the opens are crucial, they don't quite always give us the kind of open plays or the aggressive open plays that you used to see. However, there are some very key opportunities when talking about the open or the market open. So note, the market open is the most anticipated trading time because players have had time to adjust perception, strategize, and determine changes based on the overnight markets. Again, also remember that you go back into history a little bit and, with markets, because all the markets used to shut at a certain time, with the advent now of almost 24-hour markets, business can be done in highly correlated markets if need be. And that is why, the open trade, is not as aggressive as what it would have been a couple of years ago. It is important, and that is why we're going to pay attention to it. So note, when talking about the open, the context is key when interpreting the open. So where are we opening in context? Now, the more confidence in the auctioning of the open, the higher is the probability of continuing in that direction. So what we're going to talk about is I'm going to show you 4 different types of opens, and I'm going to show them to you from a strong level of conviction to a weak level of conviction. Again, just like when we spoke about the 5 different day types, we're going to talk about 4 different types of opens. And again, I'm going to show them to you so that you can get an understanding of when there's an aggressive, strong, intentional type open versus a sort of more lackluster two-way trade, sort of passive type open. Now, as you can see in the illustration, we're using the example of a European or a traditional European market with the first hour of trade or the initial balance being the K and the L print. Now, how that market moves in that first hour is crucial, not just for what happens, when the cash markets come in, but what could happen over the course of the rest of the day. Now note, there are 4 unique opening patterns. The first is the open drive, the second is the open test drive, the third is the open rejection reversal, and the fourth is merely an open auction. Let's now have a look at each one of these individually, and I'll show you a graphic depiction of each. The first type and the most aggressive is the open drive. Now, you will see this play across multiple markets, and when you see this play, you need to be so switched on and alert because it brings with it great opportunity. So the first thing I'm going to do is, before we move through the text, I just want you to cast your eyes upon both illustrations. The first one you can see is just a basic drawing of what an open drive looks like. The big O is where we open. Now, as you can see, we open almost at the extreme. This could be obviously up or down. Now, when we open, trade is very quickly, prices are very quickly moved in one direction or the other with very little pullback. Now, if you look at the actual volume profile provided, look at the K and the L prints. Look how very little overlap there is, how much volatility there is relative to the rest of the day, and how quickly the market navigates from lower prices to higher prices. Now, this open drive or this early initiative sets the tone not just for the early morning or the cash open, but for the rest of the day. So firstly, open drives are the most convicted open, where long-term participants make decisions pre-open to move the markets intentionally. So there's a intention and initiative taken right from the gun when the markets open up. Note, it's an aggressive auction in one direction. There's the lowest odds of opening prices being revisited. So when we see this open drive, the probability of retesting those prices is very, very low. By that token, if we know it's a low probability to retest them, it gives us already a strong lean towards one direction or the other. Note that early open price or that early traded price, if it does get revisited, okay, it's an extremely important reference point. So if it does get revisited, not only is it sending us an important clue, but we now know that there's a strong potential for an aggressive move in the opposite direction. Note, we want to see volume increase to confirm that this isn't just an open test drive. We will talk about an open test drive in further slides, but note, you want to see, with this initiative taken very early on, you want to see higher relative volume. So what you would typically see in the initial balance is, remember we said in the initial balance the volumes are relatively low. So on this day type with this open, you want to see relatively higher volume on this open drive. Now, 2 examples of where you would typically see this is when you got an inside day break, so when the market took out the previous day's extremes relatively early on in the session or at the open, as well as obviously if we had some form of gaps in the market, which could be either technical or fundamental. So that's our first most convicted open play that you get in volume profiling. Then the next open play is the open test. So as the name suggests, the open test drive is very similar to the open drive. It's a very convicted, type pattern play. But the difference in this compared to just the open drive is that we get an initial test. Now that test can be for a number of reasons, but what we tend to see is that the market lacks that initial confidence to drive immediately, and we first get a test of a crucial sort of point in the market. So as you can see with the 2 illustrations, the market opens, it tests in one direction, tests if there's the other time frame participants at those higher or lower prices, and then then very quickly, we see the initiative in the opposite direction. Again, in this example, as you can see, the market opens at lower prices. It initially tests lower. In this example, it happened to test, the low of the week. It tested, the low of the week, and then very quickly we got a very aggressive reversal to the upside. Now, the open test drive, it tests beyond a key reference point. Now that can be a high, a low, a value, a low, a value, a high, a previous day's low, a previous week's low. It could be any key point. The important thing to understand is that it tests a key point where we might see some sort of response and initiative taken from the other side time frame. Note, what we do tend to see is we get that failed initial test, which then aggressively reversals. Again, as with the open test drive, as with the open drive, the low, it becomes a very key pivot point, not just for the morning, but for the remainder of the day. And then one of the examples you'll tend to find is, or that we would see this quite often, is when we open up and we test or even fail to extend upon the previous day's extreme. This is the most common type of open test drive you'll see in the markets. The third open and slightly less convicted type of open is the open rejection reversal. Now again, it's a slightly less convicted open than the test drive and the open test drive. We tend to trade in one direction before running into opposite side activity, or for instance, in the graphic depiction, the first one, you can see we open, market tries to move, sort of higher, and then it runs into very aggressive, sellers that initiate aggressive shorts. Now, note, once it runs into these aggressive other side time frame players, they then very quickly take advantage of those prices and reject and reverse, the initial movement. Note, when we do see an open rejection reversal, there is a lower probability of a trend day and a higher probability of a symmetrical balanced day type. So again, this is why we discuss the various open types, because they give us sort of early identification as to how the day may play out, but also what sort of strategies we'd be able to employ over the day. Again, what I just want to point out, if you look at the volume profile, you'll see the market sort of opens, and in the initial balance we can see the market sort of tries to drift and move lower. It then runs into some, not just responsive buying, but a very aggressive initiative buying, and the market very quickly rejects and reverses in the opposite direction. However, we do then for the rest of the day begin to balance out, and what we can see here is just a traditional sort of P-shaped type profile, which is also known as a short covering type day. Note again, confidence in the reversal, is seen by a lack of overlap in the TPO. So again, what we mean by that is if you can see the K and the L prints, they move lower, and the M print almost takes out the entire, sort of initial range, and that's the reversal that is seen at this open. When we do see that, we do want to look for a continuation of that reversal initially until we run into responsive other time frame players. Note again, the trade works once we're above the open. So once we start to print above that opening price, that is when it becomes suggestive of a potential for an open, rejection reverse. And note, there's a high probability once we take out that open to continue auctioning higher. Examples of what we would look for as early identifiers would be TPO tail. So as you can see in the volume profile, we have the tail there, as well as obviously where we close on the previous day, or where the market is trading in terms of trade location. A lot of the time the market can open very far away from not just where it should be opening, but where fair value is, and a lot of the time when we see this, we do tend to get these open rejection reverse. Let's now turn our attention to the last of the opens, which is the least convicted open trade type we get. So the last of the four opens is the open auction. Now, as the name suggests, the market opens and it merely begins to auction between buyers and sellers. Now, firstly, let's look at the graphic depiction. As you can see, this is an open where we kind of open, we move up, we move down, we move up, we move down, and trade is facilitated in a relatively narrow band between buyers and sellers. So very little conviction in terms of where prices are going. Now, in the example, in the in the volume profile provided, you can kind of see that the market opens and it straight away, with that dark blue line, you can see it just settles into sort of a very balanced type open play. So note, no conviction at all with this open play. We tend to open and trade both above and below the opening price. We tend to see this open play particularly when we open in a very balanced manner within the previous day's value area. So straight away, if you see the market opening, within the previous day's value in the markets that are quite symmetrical, there's a high probability you're going to get this open auction where we trade above and below the open for the first hour or couple of hours of trade. Note, the question to ask is, where does this open occur? More often than not, you will see this open in a balanced type open. However, sometimes we can see this when we open completely out of balance. And the reason for this is that when we open out of balance, we get a lot of people being dragged in, or a lot of other time frame participants being dragged in at these much higher or much lower prices, resulting in a lot of two-way auctioning between buyers and sellers. So note again, when we're in balance, it's likely to stay that way for some period of time with minimal conviction. So straight away, you got to say to yourself, bang, if the market opens and we're opening well within balance and we see quite a lot of two-way trade, we can take on strategies looking to extend above and below the opening price. Equally, if we open out of balance, we can see the same sort of open, just with a little bit more volatility, and again trading both above and below the opening price. So that is pretty much our open auction. And note, it's important when thinking and talking about the open, open auction type trade, we want to be talking about it in terms of, is it within balance or out of balance, as this will determine, how we take on the trade and the approach we use to take on the open auction trade. So as you can see, as we've discussed all these principles of symmetry and balance and the open plays and the types of day types you can expect, straight away you should be starting to say to yourself, well, I'm going to need some form of a template so that I can not only identify, the early observations, but equally identify, the potential hypothesis that you can develop based on the information, or the objective information being shown to you by the volume profile. So what we're going to talk about now is a little bit about the pre-open routine that a trader would take. And then what I'm going to do is, when we eventually get to our playbook, I'm going to give you a template that you can not only complete for yourself, but you can develop for yourself so that you don't miss out on any of the objective information that the market is trying to show you. So what would a typical pre-open routine of a trader look like? Well, first of all, trade location. Where are we trading? Now, in the next slide, we are going to talk a little bit more about trade location, but merely trade location is where we are trading relative to past trade. You then want to think about the overnight dynamics. In other words, what have your key markets, like if you're trading the European session, what has the Japanese yen done, or what has the gold bullion done, or what have the US bond markets done, the Asian bourses done, and the dollar? You need to understand, have these markets shown any kind of initiative, or have they been moving sideways? If they are showing aggressive intent or volatility, all right, that is going to spill over into the markets you trade, the next session. We'll then determine our opening call. So once we've sort of understood, where we're trading and what the overnight dynamics are, we'll then determine where the market should open based on where it closed the previous day and the relative overnight moves. Again, we need to interpret, where it's opening relative to where it should open, as this will throw up potential early opportunities. Then we need to have a look at, once the market opens, how much conviction is there by watching the open play. So remember, we spoke about the 4 open plays, being the open drive, the open test drive, the open rejection reversal, and the auction open. Now, depending on which open it is, we can develop a level of conviction as well as the level of, or hypothesis for what may occur as the day progresses. Then, where does the open play occur? Is it in value? Is it in and out of range? And all these sorts of questions again are going to be feeding us objective information about what the market may potentially do. Now note, within the first hour of trade, you should develop a hypothesis based on the conviction being shown at the, by the market at that point. Remember, conviction is not your conviction; it's the conviction or the factual conviction that the market is showing us. Now remember, if we see a market opening imbalance with a very basic open auction, there's a low level of conviction. However, if we see the market open out of balance with an open drive, there's a high level of conviction. The 2 hypotheses we'll formulate on these 2 opens will be greatly different. And then note, where will other market participants be drawn in? So important to have those, remember those key pivot points or trigger points where, one, we may see initiative, or where we may see, further responsive type pattern behavior. So it's crucial that, whilst the day develops, we do recognize those potential areas for further initiative and volatility and volume, as well as maybe a lack of volume and volatility and responsive trade. And then, what are our statistics? This is so crucial. What's the average range of the day, of the hour, of the month? What's the average volume that's going through? What's the average rotation of that the buyers and sellers are currently doing? All these sorts of statistics will add so much value to your understanding and interpretation, not just of where markets are, but where they could potentially go in the future. Let's now have a look a little bit more closely at what we mean by trade location. So like we said previously, the trade location is nothing more than where prices are opening based on, in day trading, based on the previous day's, structure. If you're a weekly or a monthly or a longer term swing trader, well, trade location is then more where are we trading relative to, the markets, if it's bracketing or trending, in relative terms, where are we trading? That is the trade location. So we use the previous day not for levels. Note, we don't go and look at the previous day and say, well, the market stopped at this low and stopped at this high, therefore that's support and resistance. No, we use the previous day to identify, things like value, things like balance, things like acceptance, important pivots where we might have seen initiative or rejection. That is what we use the previous day for. We use it to identify important reference points. Now, trade location is merely where trade is being facilitated today relative to yesterday. Okay, when we use the trade location to interpret market weaknesses and strengths, we can then determine whether there's confidence or a lack of confidence. So for example, let's say the previous session we had a relatively muted session, a balanced market trading within the previous day's value accepted area. Now, on the next morning, the market tries to open drive, but cannot, see the kind of volume and volatility it requires, to continue and extend to the upside. Now, straight away, we expect to see confidence with an open drive. So if we're not seeing it, it's telling us that, whilst there might be a little bit of confidence, it's not as strong. So we lean on the previous day's sort of referencing points to determine the level of confidence or lack of confidence. Then, the 3 trade locations or basic trade locations we get that we can identify based on the previous session are, firstly, if we open in value area. So if we open within the previous day's value area inside of the previous day's range. The second trade location is if we open outside of the previous day's value area or accepted value area, but still within the previous day's range. And the last trade location is if we open up completely outside of the previous day's value area as well as the previous day's range. Now, straight away, you should be saying in your head, we're going from balanced to more imbalanced in terms of our trade location. If you've just caught that, then you understand why we talk about trade location. The further we open away from, the previous day's value and range, the more likelihood there is for excessive volatility. Now remember, volatility does not necessarily imply volume, but it does potentially imply opportunity. Why? Because it's bringing and forcing other time frames as we're advertising quite substantially different prices from the previous day. So simply, keeping track of where the market opens relative to the previous day's range and value is a valuable market-generated piece of information. A market that opens within value is generally in balance and waiting for new information. A market that opens outside of value is out of balance and carries it with it greater opportunity and risk. So by using the previous day's factual information combined with the opening auction process, we can trade more objectively, and that is why we identify the trade location based on the previous day. The basic premise: if we open in balance, there is equal opportunity for us to move up and down. The further we open away from balance and potentially outside of range, the higher probability for volatility, and this brings greater opportunity as well as obviously greater risk when trading. Identifying this, we need to use the strategies that will best allow us to take advantage of those opportunities based on where we're opening in terms of the trade location. So let's look now at each one of these, three trade opens or trade locations that we spoke about. Now, the first one, as you can see with the chart, is with a basic profile, drawing on the left. You can see the market opens between the two lines, which is depicting the value area. So you can see when the market opens within the previous day's value area, within balance, we tend to spend, a lot of the initial trade auctioning out the previous day's value area. So straight away, just looking at this basic example, when we open in value, in range, we tend to get a lot of overlapping value area. Even using the volume profile example, you can see how much the market the next day actually traded within the previous day's value area. Now note just a few observations. When we are in value, in range, we are firmly in balance. So we get a lot of overlapping TPO, a lot of overlapping price, a lot of two-way trade. The trade risk and the opportunities are therefore low. Note, the day's range is likely, in other words, the next day's range, when we open in value, is likely to be very, very similar to the previous day's range, with maybe potential for a slight extension. So straight away, when we're opening in balance in value, the day's range today is likely to be similar to the previous day's range. Again, knowing something as simple as this will keep you from being too aggressive with your momentum plays and too aggressive from looking for big potential winners. And then note, once the extreme point is determined, we can then establish what the potential range will be for the day. So if you utilized one of the the topping out patterns that we spoke about earlier, then once that top has been formed, or we get a little bit of an excess tail, you can then identify what the potential range is or what the potential opportunity is that you can take advantage of. So that's our first type of open trade location. The second type of trade location is where we open outside of value but still in the previous day's range. Again, looking at the example, we're now opening outside of that orange area or outside of the previous day's accepted value area. Now again, remember what we said was when the market opens outside, it's not as balanced, but it's still relatively imbalanced so long as the previous day's extremes remain intact. It's when those extremes get taken out that we then start to see a little bit more volatility in the market. Now, note, due to this opening out of balance, there's a higher risk, but a higher opportunity for trades. then the extension of the previous day's extreme will bring a much higher sort of a bias towards outside value. So what we're trying to say here is that when the market opens outside of value and breaks out of the previous day's range, there's a high probability that on that day type we are going to accept value outside of the previous day's value area. So again, it's not to say that we're going to open and initiate or trend higher, but there's a high likelihood that when the market shuts on that second day, the value area will be a lot higher than the previous day's value area. And you can see this in the example where the orange area being the first day's value area. Once the second day finally finished, we can see how we have a much higher value area than the first day type. Then note again, when we do have these open out of values but in range, we do lean on the previous day's extreme quite a lot as a potential reference point. And then last but not least, what we're going to move to is our opening out of the value area and opening out of range. Now this is the most exciting of the trade locations because it's going to bring quite a lot of volatility with it. But as you'll see when we move on to the next slide, we're going to talk about three of the strategies you can utilize when talking about an open out of range and out of value area day type. Now, the first thing to understand is that we are completely opening out of balance. So when we open completely out of balance, high volatility. Right, high volatility means a lot of potential for a lot of very snappy, aggressive type moves, either up or down. Now, again, it's important to understand that the range potential in this example is completely undefined and unlimited. So when you get this day type or a gap, also known as a gap, how high or low the market goes is unlimited. No one knows. It's all dependent on how people respond to this very aggressive trade location. Again, remember, when we open out of range, we do get a lot of people being drawn into the market. They're forced to act because prices have moved very aggressively away from where they were trading in the previous session. So again, the size of the initial balance is quite important here. What I would say is, in terms of the initial balance, we do tend to see relatively wider initial balances than normal. And the reason is very simple, is that we have got people that are forced to act very early on as they respond to the very high or low prices. Now, time is a very key component in this when we open out a range, and the reason being is that what we initially see is the market will always try and fill in what we like to think of as the gap. So when we open sort of out of range from the previous day, the market will always try and fill that gap in. So time is crucial. If it cannot fill that gap in early, it's telling us about the potential likelihood for trend in the direction of the gap, or at least movement in the direction of the gap. So we have three scenarios that we're going to look at in the next slide, but just let's go through the graphic depiction. As you can see, the market value area previously was a lot higher. We then opened below the previous day's range. Straight away, the market sort of facilitated trade toward the downside. We saw prices move towards the downside. But then later on the day, once we took out the open, we started to see prices drift a little bit higher. And again, note how when we open out of balance and out of range, the value area tends to be quite far away from the previous day's value area. So let's now go and take this third type of trade location and look at some of the very key strategies we can develop and take on when talking about a market being out of value and out of range.
So how do we trade the gap rule? Well, this is one of my favorite trade setups, and for good reason. We've got 4 different unique plays we can implement when talking about gaps and trade strategy. Now, I'm going to show you the basic principles and the basic pattern play behind what a gap day would look like. Before we get to that, let's just discuss what types of gaps we get. Okay, so the first we get is a technical gap, and the second would be a fundamental gap. Now don't forget, guys, a gap in its own is a form of excess.
Okay, it's showing us the market is highly skewed, or there's a real lack of balance in the marketplace. So what we need to interpret firstly is what has created this excess, or this very, very non-symmetrical shape in the market. Well, firstly, could it be technical? In other words, have we had a huge move overnight in, say, Asia, and as a result, the market is, opening up below an area of stop-out positions or a liquidation period? So that's the first thing we need to interpret. What has created the gap in the market? Second, is it a fundamental gap? In other words, have we received some form of information overnight, some sort of a, something from maybe a central bank, or maybe there's some huge political news out? Is there a fundamental reason that price needs to very aggressively shift? So that's the first thing we need to interpret. Now, the reason is because technical gaps have a high probability, or a higher probability, of actually filling not just in that session, but in sessions thereafter. Whereas fundamental gaps, on the other hand, they have a slightly lower probability of filling within that session, and even sometimes later sessions. So that's the first thing we want to interpret when talking about gaps and excess. Now, the play is very simple. Okay? We want to interpret whether or not the gap holds. Now, as a rule of thumb, always remember, if the gap holds in the market, so let's say that's our previous day's low, and let's say this is the previous day's opening price. Now, this gap effectively tells us there's initiative, or potential for initiative, or skew, or probability. So straight away, you should see gap, you should see something like maybe dollar signs, because that's what a gap means. A gap means there is potential for opportunity and probability in the market. Now remember what we spoke about in earlier slides. We said when there's a skew in the market, or a market that's out of balance, it's going to force lots of different positions, whether it's initiative positions, whether it's responsive buying, whether it's initiative selling. It's going to force a lot of business, or a lot of players into the market, because suddenly prices shifted from there down to there. Now, that creates opportunity for us as traders. However, we need to have unique strategies to implement and take advantage of the gap. So the first and most aggressive type of gap trade strategy will be where the gap does not fill. So let's take a look at what this example would typically look like. So we have the previous day's profile. We then have the gap formed, and today we've opened and gapped on the previous day's range. Now, the first example is where the market opens, it facilitates trade in either direction, we distribute, but we cannot fill in the gap to the outside even after attempting. Now, this is the key to this trade strategy. We need to see the attempt made. Now, this attempt would typically come as the cash market opens. Now, a lot of traders, what they tend to do is they get a little bit too aggressive in these gap strategies, and the reason is because they've come in, they've heard this news, they're thinking, oh, I better get on it, otherwise I'm going to miss it. And what they end up doing is they end up getting on that down leg, whilst the market is just trying to find a little bit of balance after having gapped. Remember, guys, when a market has gapped, let's say this market has gapped down 2%. That's a relatively large move. In other words, the market should almost be fully reflecting the new information. So bear that in mind, that the market needs to attempt. We need to see the K print, the L print, maybe the N print, the N print, and we need to see maybe a couple prints. Well, it doesn't matter what they are. We need to see a couple of prints failing to fill that gap in. Once we fail to fill that gap in and the market starts to look a little bit top heavy and starts to rotate lower and hold higher or lower and lower auctions, we then should see a continuation of the trend. So that's the most aggressive type of gap rule. But remember, we need to first see the attempt made at filling the gap. Now, let's take the second most aggressive example, where the market fills the gap but fails to re-enter the previous day's range. So we have our gap, the market opens lower, it trades both sides, and it starts to distribute, and eventually it distributes all the way up and fills the previous day's range. So we no longer have a gap in the market. Now, this is the second most aggressive, because if the market cannot get back inside the previous day's range, it's telling us that we still have quite a strong sentiment towards the downside. Now, the key to this trade strategy is, again, a little bit of patience. This is the one we tend to find that occurs most often with gaps. Markets don't like to leave gaps. Why? Because structurally, they look very awkward. Structurally, they don't make much sense. So very often, the market tends to fill in the gap, but once it's kind of filled that gap in, it can then look to continue to distribute lower. Now, the key with this strategy is to allow the market to fill that gap, to allow the market to show us that a top is now in place. And once it's allowed us and showed us that top, whether it's a top formed on a tail, it's a top formed on maybe a slowing momentum, whatever it may be, once that top is formed, we then start to see again the distribution towards the downside or the lower end of the profile. So again, the reason we talk about the most aggressive and second most aggressive is that these are the most likely to show us or to hold the natural short-term bias, which in this case, because the gap is to the downside, will be to the downside. Now the third, and again, this one's also particularly good to trade, is when we actually get the gap that gets filled and we re-enter the previous day's range. So again, we gap. The market facilitates trade on both sides. However, after distributing for most of the morning, we then re-enter into the previous day's range. Now, the key with this strategy, and listen carefully because this is a particularly good strategy, the key with this strategy is to ask yourself what has created the gap, and it comes back to the question of, is it technical or fundamental? Now, the reason this is a key strategy is because if there is a fundamental reasoning behind the gap, you are going to get a lot of positioning. Okay, now what do I mean by that? So let's say overnight we hear some very, very aggressive news. A lot of short-term traders come into the market and all they're thinking is about the fundamentals. So we have a lot of aggressive shorts that have initiated new business in the market. Now, by that very token, if people are initiating shorts, but the market cannot go down, it's telling us there's going to be a lot of short-term trapped short positions. And once those short-term positions get squeezed a little bit too far, we tend to get a very aggressive reversal in the opposite direction. The last and the most sort of aggressive reversal type price response is where we actually not only get into the previous day's value area, but we then extend to the other side of the previous day's value area. So this is very similar to the third example. The only difference is we lean on the previous day's value or volume value area low. So that becomes a key pivot for us. If the market initially holds this area as resistance, let me make this a little bit better. So the market holds this initial as resistance, but then it starts to trade above it, it's highly likely we're going to trade very quickly and aggressively to the other side of accepted value. So that would be the fourth example we'd look for, and it's very similar to the third. The only difference is we have a calculated target, which would be once we get above the previous day's value area low, we tend to then target the previous day's value area high. So those are the four examples. Now, the reason I show you these strategies, again, it's not that I want you to necessarily become, a professional gap trader. What I just want to point out to you is that when there are gaps in the markets, on any day, it doesn't matter which day of the year it is or which market, when there is a gap, already I have got 4 trade opportunities listed on any given day where there's a gap. So straight away, I have a strategy, I have an approach as to how I'm going to trade gap days. All I have to do is just follow the structured strategies I've shown you and execute accordingly. If you follow this roadmap, guys, you will succeed at not just the trading, but at developing some fantastic trade opportunities. So that's our gap rule trade strategy. I hope you've enjoyed that, and we'll catch up again in the next few slides. So welcome back to the Blackboard series part 6b. Now, what did we talk about in the early section of part 6? Well, we started off talking about markets that open in balance and markets that open out of balance. Now, the important thing to understand when talking about a market opening within balance or trading within balance and out of balance is what the implications mean for risk and reward. So very basically, to depict the example, if we had that being our previous day's distribution, and this was our sort of our accepted area of volume, or our where 70% of the trade was distributed. Now, if we open the next day somewhere within the previous day's accepted area where 70% of the volume is traded, that market is said to be in balance. Now, when we trade in balance with the previous day, there's a lot of acceptance between buyers and sellers at those prices, and for that very reason we have much lower risk attached to the market aggressively moving in one direction or the other. And of course this can change over a period of a session or a couple of sessions, but initially there's a lower probability for aggressiveness on either side. However, also remember, with lower probability of risk, there's also lower probability of opportunity. In other words, we need to almost bide our time and be a lot more patient, waiting for strategy to develop. So that was our first example. We then turned our attention to markets that are out of balance. Now, utilizing the same example, if we open somewhere in the sort of the top quartile or somewhere in the bottom quartile, that would be a market that is opening out of balance. Now again, the converse to imbalance is that a market out of balance shows a lot more volatility as a result of being out of balance. This volatility implies that there's higher risk in taking trade setups, but equally higher opportunity for opportunities to take advantage of those opportunities. So again, it's important to understand when we're in balance, that means lower risk, less opportunity. When we're out of balance, that means higher risk, but also higher or more opportunities to make money. So that is what we started off with. We then moved on and spoke about the 4 unique open trade patterns. I spoke about some of the characteristics of these open patterns and the levels of confidence they give you in the potential for opportunity over the course of the day. Now, what we're going to quickly do is I'm just going to go over the 4 patterns with you again, just to refresh your memory. The first one we had was an open drive, which is also the most aggressive of the patterns. So the market opens and it initiates in one direction. And once the cash market comes in, this initial, what we call a tail, gives us the strong bias for prices to continue upward over the initial part of the session. Most important, we said, that opening price becomes a key reference point for us in the market. So that was our first most aggressive trade open pattern that we saw. Our next trade pattern that we saw would be the open test drive. So again, the market would open. It would then test a key reference point. Now that reference point could be a low of day, it could be maybe a value area low, it could be a volume pointer control, it could be any number of things. It could be a low volume area, but merely it tests, it almost pokes to see, is there going to be some sort of an initiative response from buyers in this case. That's what it does. And once it finds them or runs into that, that longer time frame, the market very aggressively catapults in the opposite direction and we get the initiative move. Again, the open test drive is quite an aggressive play. We do tend to look for sort of strategies that can be employed towards the upside so long as this K-tail and this opening level remain. That was our second open type we could see in the markets. The third open type was the open rejection reversal. Now, this play type is similar to the open test drive, but it really it can be quite a confusing play because the market will open, it will then move in one direction, but it will look as though the early trend is toward the downside. But in effect, what's occurring is the market is just trying to find, where the liquidity is going to come from, where we're going to see some very strong responsive buying step into the market. And once it finds that responsive buying, the market then turns around, retests that opening price, but more importantly, catapults above the opening price. Now, again, that low does form an important low in the market. It is a point where we saw some very strong initiative being taken by some responsive buyers. So that's our third open day type, and our fourth is the open auction. Now, the open auction is probably the most boring of the four and also represents maybe the least opportunity in the sense that there's no natural bias for direction. So the open auction is merely the market opens, it can auction up, it can auction down, it then goes up, it then goes down, and it merely just distributes in a balancing type open. Now, there's a high tendency to find this open in both balanced and imbalanced markets. The important thing is to identify early on, if the market's auctioning on both sides of the open, there's a high likelihood of early balance, in the market, or let me rephrase, early distribution in the market. So those are the four types of opens we spoke about. We then discussed our three trade locations in the market in terms of where the previous day's volume value area is. The first would be if this is our previous day's distribution, and this is our value area, or our volume value area. The first would be when we open in balance, the first would be when we open in value in range. So we open within the previous day's most accepted value area. The second would be if we open out of value but still in range. So again, we either open below or above the value area low and the value area high, volume value area, volume value area. So that would be where we still open in range but slightly out of balance. And the third, which is the most aggressive and the most significant, would be when we open out of value but also out of range. So those are the three types of trade locations we spoke about. And we mentioned what the different trade locations imply for the potential for opportunity. Then what we spoke about was some very, very strong strategies that you can employ when you see gaps in the market. So go over those examples again. Go over the Blackboard Learning Series where we spoke about gaps. Develop those strategies for yourself so that you can understand and interpret and trade the gap days very effectively. This is the end of part 6. Good luck with your playbook completion, and we'll see you again in part 7. So we're now at the end of part 6, and I hope you've sort of started to see now how we're finally starting to develop various strategies around various principles that we're developing within the volume profiling course. So some of the questions I need you to check over, and I need you to just make sure you understand before moving on to your playbook are as follows. So how often do markets bracket, and how often do they trend? Again, rough estimation. It's not an exact percentage. It's going to vary based on the time, the fundamentals in the market, but roughly how often are we bracketing and how often are we trending? Then define and interpret the 3 ways the markets tend to form turning points. Again, crucial. Remember those 3 turning points. I'll give you a little hint. Momentum loss and a little bit of excess and tail. Those are the kind of things you want to think about when referring to potential turning points. And then, what is volume and what is volatility, and why do they impact, the strategy creation? So crucial you understand that, and so crucial you add, the 2 elements of volume and volatility, not just to your understanding, but to your strategy formulation. And then fourthly, list the 4 types of market opens. Again, crucial. The way the market opens shows us either early conviction, which is strong, or low conviction. And then lastly, last question, list the 3 types of trade locations. And when you list them, again, think in your head, why are these trade locations important? Why is it important whether we open in balance or out of balance? Again, all this kind of thinking is going to get you to start formulating strategies based on market-generated information, fact-based information, as opposed to just looking at a chart and saying, well, this is a buy and this is a sell. Good luck with those concept checkers, and we'll see you in the playbook section. Welcome back to the playbook, guys, and firstly, question: find and insert an example of a bracketing market and a trending market, and put it in the space provided. So, one of the 4 markets: Eurodollar FX, oil, bunds, or E-mini S&Ps. Find an example, a nice strong example of a volume profile that's showing us bracketing, and then a volume profiling that's showing us trend or one time framing. Then the next question, find examples of the 3 turning points we discussed in part 6 and insert them in the space provided. Again, pay special attention to differentiating between the sort of slow loss of momentum open, the excess the slow loss of momentum top, the excess top, as well as then the extreme excess top. Again, try and differentiate between those key characteristics, because if you can early identify what those characteristics are, you will then not only develop your understanding of how turning points are formulated, but you'll then be able to sort of identify this pattern over a varying number of markets. Then, in the space provided, draw the 4 types of market open. So just visually draw them. What do they look like? Bang, open drive, open test drive, open rejection reversal, and the auction open. Fourth, in the space provided, draw the 3 main trade locations. So what are those 3 trade locations that are very often exhibited in volume profiling? And lastly, very exciting, we're finally going to begin our section at the bottom of your playbook, which are our strategies. This is probably the most important part of your playbook. Spend a lot of time on this. Don't rush through this process, because when you start progressing in your volume profiling career as a trader, you're going to constantly be leaning on these strategies I'm developing with you. You're going to be constantly upgrading them and adding to them. So take a lot of time developing these strategies. This is going to become your bread and butter. So using the 3 unique strategies, which are the inside daybreak, the V reversal, and the gap trades that we discussed in part 6, find an example of these strategies in the Eurodollar, the E-mini S&P 500, the WTI oil, and the German bund, and add them at the end of the playbook. Now, the reason I want you to do it in all 4 markets is for very good reason. If you do it in all 4 markets, it's going to make you realize that these basic 3 strategies occur not just in these 4 markets, but in any markets. And that the important thing when developing a strategy is to understand it's not so much about the strategy, but it's about understanding the principle underlying the strategy. If you can do that, not only are you going to develop the strategies I'm showing you, but you're going to start to develop your own unique strategies. Good luck, and we'll catch you again in part 7.